you, Professor Manikowski and Professor Park. Our second speaker is Professor So Jung Park and Mr. Dongjun Lee at Seoul National University in Korea, here to talk about financial literacy and choice of insurance products. This session is until 5 p.m. Okay.
But we still need some time for discussion, right? 그 디스커션까지 합해서 5시죠. 그러면 한 15분 해야 되나? 1시간 좋겠네. 오케이. 네. Right. Okay, thank you very much for being here. So today I am going to present my research paper with my former graduate student Dongjun Lee, the topic of financial literacy and choice of insurance product. So this topic of financial literacy actually I wasn't really aware of this literature, and this is actually my first study doing some research on this area. Actually, I started this study because of this academic association, actually. So insurance demand. This study is about try to find a relationship between financial literacy and insurance demand, especially the life insurance demand. And what is it about insurance demand? So it's, the literature on insurance demand is basically you try to see who buys more insurance and who buys less insurance. Why do people buy insurance? It's really based on that, you know, the theoretical models. And especially when it comes to the theory models of life insurance consumption, this Yaris paper and Lucy's paper is really very well-known theoretical development which explains that insurance demand under the framework of this neoclassical utility theory. And they provide this life cycle model and why do people buy insurance and how much insurance is the optimal and it shows something like that. And based on these models, we can you know, draw some hypotheses like, you know, the risk aversion and wealth, income, inflation, independence, bequest motive and life expectancy, things like this could affect the decision of life insurance demand. And based on these theoretical studies, there has been lots of empirical work trying to find that relationship between these factors and actual life insurance consumption. Under the neoclassical model, what is missing, I think, is people are really rational and they make this insurance consumption decision to maximize their expected utility under that very complicated life cycle model. But maybe this is not the case. A lot of, you know, behavior economics literature is developing, and if we kind of started thinking about this thing, then we can probably thinking about the relationship between financial literacy and the insurance consumption. So the traditional studies kind of ignore this part of financial literacy and just assume that everybody's really smart and knows everything and this is the optimal consumption, therefore I buy this amount of insurance. But if we started thinking about this, you know, financial literacy or capability, then we can probably view this issue of insurance demand as a slightly different angle. And I found one relevant study, relatively recent study published on Pacific Basin Financial Journal. And they try to find the relationship between life insurance demand and financial literacy. And they do find the positive relationship there. And actually, as you may know, that this APRIA conference is going on. Actually, today and yesterday, we have two conferences together. And yesterday they had this behavior economics session, and looks like there was one nice working paper trying to find that life insurance demand and financial literacy. And so it looks like these issues has been tested recently. But even before this financial literacy story, a lot of studies, empirical studies in life insurance demand, they try to see the relationship between education and the demand of life insurance. But looks like we all know that education itself and financial literacy is not one-to-one connected. Even if we get more education, that doesn't necessarily mean we can have better decision making in when it comes to financial decision. That's one thing. And also the previous literature, when they use education as a factor, usually they kind of use this as a proxy for risk aversion kind of thing, instead of looking at this as a financial capability or literacy proxy. So the first thing I want to see is, like in other studies, I try to see the link between financial literacy and life insurance consumption. And the second thing that I want to look at through this research study was, I questioned about the adequacy of insurance demand. So is the better, more the better? Like you have pretty much all the studies kind of emphasize that we are underinsured. There's a huge gap in life insurance demand. So we probably need to buy more life insurance. Then who buys more? Better educated, higher income, etc. But my question was, is more actually the better? There should be some adequate level of life insurance, and my question was whether this financial literacy make us to make a better decision. So when you actually need insurance combined with financial literacy, can it actually improve your decision making process in about life insurance? That was kind of my question. And I found this nice study about adequacy of life insurance published in AER paper. And what they have found is there is a huge mismatch between life insurance holdings and financial vulnerability. So it looks like, okay, people are buying lots of insurance. Some people buy less and some people buy more. But looks like there is a huge gap between mismatch between financial vulnerability. So when the people who need life insurance, it's not like people who need life insurance buy more life insurance. So when it comes to the adequacy, maybe there is a huge a gap between this life insurance holdings and financial vulnerability. So my hypothesis, that the real thing that I want to test through this study was, okay, first I want to see whether there is a real positive relationship between financial literacy and life insurance demand. And also I want to see some sort of adequacy hypothesis, whether the people who need insurance actually buy more life insurance. And the needs, I measured that, I estimate that as whether the person has dependent children or not. So the people with the dependent children, do they buy more life insurance? That's my second hypothesis. And the third one, actually, that's the most important thing. So then better informed, educated, literate individuals. When you have a higher financial literacy, do they buy more adequate coverage, which is like the people with a better financial knowledge and better financial socialization, like a propensity to plan, do they make better insurance decisions? So that's my testing hypothesis. To test these ideas, I use this Consumer Financial Protection Bureau's survey data, US data, with over 1,000 survey results, which has very comprehensive variables about individual characteristics, household characteristics, and income and employment characteristics. And also it has some savings and investment information, and also has some information about whether you have life insurance and health insurance and etc. And also have some information about financial experience. And then we have this important information about financial literacy, financial socialization, and financial knowledge and skills, and etc. So I want to link this part with this insurance information controlling for other characteristics. So that's what I am going to do. So here is my specification. The dependency variable here is whether this person has life insurance or not, especially the life but here it's like dummy variable having life insurance. And I have a bunch of the control variables which have some relationship, like income and education, etc. I will control for that. And insurance needs here, I'm going to use that children to support financially as a proxy for life insurance demand. And then I will have this financial literacy variables to see whether better, people with a higher financial literacy actually have more life insurance. So that's the first thing that's like my base model. And in addition to that, what I am going to do is this is my main regression. Everything else the same, but then I am going to add this interaction term, which is the interaction term of insurance needs children to support multiplied by the financial literacy related variables. So when you have higher financial literacy, so you have higher capability of making right decisions, those people, do they really buy more insurance when they have dependent children? That was my main question. And here I have the results. In my sample, about half people have life insurance and about half doesn't. And if you compare this, you need variable analysis. Looks like all these variables, the people who have better financial knowledge in terms of objective financial knowledge, subjective financial knowledge, and also financial socialization, which means like we have some people talk about these financial matters, and also propensity to plan. All these, the people with life insurance had higher values, and also children to support has huge difference. So people do buy life insurance when they have children to support. When they are really exposed to the risk, then people buy life insurance. So pretty much people are smart enough in this sense. And here's the regression result. So this, you can ignore this part. So the first, few variables are the variable of interest. Yes, as we have expected, this knowledge, financial knowledge score, and financial socialization, propensity to plan, subjective financial knowledge, children that I support financially, all these variables are very positive and statistically significant, supporting the very basic hypothesis. Yes, I know more, I have children, so I buy more life insurance. That was the case. And the second part, I split the sample a little bit into this poverty group and kind of rich group, non-poverty group. The reason why I have conducted this analysis was, if you are really in poverty group, like, even if you have financial knowledge whatsoever, you don't have money to buy life insurance. So your life insurance probably is not driven by whatever, knowledge whatsoever. So I thought maybe this effect should be stronger among this, non-poverty group. And that's what I have found in this study. And interestingly, actually, when it comes to poverty group, the strong variable was this one, financial socialization. when you have some people, kind of giving financial advice around you, somehow, even if you are in poverty group, people tend to buy more life insurance. Who knows? The life insurance agents are around, and they think they get the advice from those people. That was one possibility. And the second thing is, this is my main analysis. The interaction terms are now here, as we have expected high financial knowledge score. I know it's like the testing of finance exam, so I have higher score in this interesting exam. Then when I have triggered the support, then I buy more life insurance. I know more about finance than those people who know more about finance actually buy more life insurance when there's needs, then they actually go ahead and buy more life insurance. And actually this financial socialization variable was negative. You have people around, maybe people are giving you bad advice. So the sign was actually negative. But for test the plan and subjective knowledge, all other things actually had positive relationship as expected. And I thought this was kind of interesting, and this negative effect, they all came from the poverty group. So for those who are in their poverty group, they buy more life insurance when they have people giving advice, the people around giving advice. They buy less insurance when they have children to support. Actually, the coefficient of the two is almost the same, so it kind of cancels out. So they just make you buy more insurance irrelevant to the risk that you are exposed to. But that was not the similar result was not really found in this rich group. That was my result. And I've done a few robustness check here for endogeneity issue. Because I think there is, this morning in plenary session, Professor Hana also mentioned this issue. When you have financial literacy, there is some sort of endogeneity issue because you became aware of these things because you have studied or you are smart enough, or it's possible that you have really experienced this purchasing process. So you know more about life insurance because you have purchased it. So I think there could be some sort of endogeneity issue. Like I know more about life insurance, therefore I buy life insurance. Maybe that's not the case. It's like because I have life insurance, I know more about life insurance, right? So there could be this endogeneity issue. So for that reason, in this when we construct this financial knowledge measure, there's one question about knowing very well about life insurance. So I excluded that one question to kind of to away with to get around with the endogeneity issue. So I ran regression with and without this life insurance, specific knowledge about life insurance. And basically the results didn't change that much. That is my conclusion. And I did another exactly same set of regression. I ran multiple regressions using now health insurance instead of life insurance. Why did I do that? Because I use this children to support is kind of the main variable that I use in this analysis that should affect the life insurance decision, but not necessarily the health insurance decision. And to check whether this children to support really accurately measure the life insurance demand kind of thing, I just simply run the same stuff. And it found basically there's no relationship whatsoever at all between the interaction terms and health insurance, although it was very important for life insurance decision. And some discussions and future study. Actually, when I first started this project, what I really wanted to do was, okay, whether the financial literacy will improve your decision about life insurance consumption, and then that correct kind of an adequate life insurance consumption will improve your financial well-being. Was like, that was my goal. But so in order to do that, I want to run some sort of relationship between, whether having life insurance will improve your financial well-being. So I'm going to run some regressions like that, although, and I did find some sort of little positive result. But this setup actually have a very serious reverse causality or endogeneity problem, I think, because those people who have high financial well-being will have life insurance. So it's like, there's a huge problem with this endogeneity. So at this version of study, I kind of just excluded, dumped this out. But at the end of the day, later, probably I still want to find out a way to test this idea and not having. I mean, anyway, I need to find out another identification strategy to answer this question, the relationship between having insurance and financial well-being. And that is it. Thank you for listening and have a nice Friday. Thank you.